there is still that question in the back of your mind of who's going to carry this business forward when I exit.
How you set up and plan your business for that exit is going to be heavily dependent on what it is that you're going to do after.
There's an aspect of you're the founder, you were the rainmaker, you helped build it, you wear multiple hats. And in order to do a successful succession, you kind of need to start checking your ego.
Welcome to the Total Succession Show. I'm your host, Tyson Ray, joined by Kim Cochenour. We're glad you're here. Subscribe at totalsuccession.com/podcast and let each episode guide you closer to a confident, well-planned exit. Today's conversation just might be the nudge you need to start preparing for what's next.
Hey everyone, and welcome back to the Total Succession podcast. This episode is one I've been looking forward to because we're talking about some big shifts happening in the industry. And we've got just the guy to unpack them with. Nick Arellano is here with us. He's a partner at Your Legacy Partners. And if there's one thing Nick knows, it's how to help advisors plan for what's next, whether that's succession, retirement, selling a practice, or building something that lasts beyond you. Nick's been in those conversations day in and day out.
I've had the opportunity to actually work with Nick, and when we actually went and got a third party and used Legacy Partners to help us get an evaluation, and it's an eye-opening experience if you actually haven't done one yourself from a third party. And so we're excited to have him on today so we can talk a little bit about what we learned along that journey and what are some best practices around this topic of succession, valuation, and how to go forward in a retirement for a financial advisor.
Nick, so welcome to the show. Thanks for joining us today.
Yeah, thanks for having me. Glad to be here.
Yeah. So before we really get into the meat of it, we'd love for you to actually tell us more about you and your firm, Your Legacy Partners.
Yeah, so I'm the managing partner, founder of Your Legacy Partners, which we kind of classify as a founder-focused exit planning and legacy planning firm. I mean, we started off doing valuations, consulting, and M&A at the core, but we really just, we saw the gap in some of the planning that even advisors who do planning are kind of doing for their transition and their own succession. And we get so much value. So we work with a number of different industries, but the vast majority of our clients are financial advisors, independent RIAs, and practices. And I was an advisor for 15 years prior to doing this, did my MBA, and then have launched this for a number of years. So enjoy working with the owners. I think that's a big gratitude to help them really focus on the value that they're getting out of the business. And I think something you'll see on our website is like, it was never about the exit. It's about what's next because we always enhance value in some of those things. But that's a brief overview.
Oh, that's great. Well, as you mentioned, advisors, Tyson says this all the time. It's like the plumber, their pipes are always leaking. They don't focus on their own planning or their own succession. So it's great to have that third party, especially at Your Legacy Partners, actually stepping in and being founder focused. So love that. Um, so, Nick, I know you and your team talk to clearly lots of advisors across the country, and you're actually seeing on the ground in real time what's happening. So, before we dive into some of the details around valuation, succession, and all of those good things, let's kind of zoom out for a second and kind of look at the bigger picture. What's happening out there right now? What trends are you seeing, and what should the advisors really be paying attention to as the landscape has shifted?
Yeah, and you're very right. We're at a very unique time in this industry, I think, which is unique for, among all industries. That is probably not going to last forever, but it's a very unique time that's actually very advantageous for a lot of RIA owners. But some of the core things we're seeing. So the age of advisors is still increasing, right? There's an estimated roughly 40% of advisors.
We all get older, we just don't realize it.
Yeah, especially some of the owners, right? They're going to retire in an estimated 40% in the next 5 to 7 years. The problem is a lot of them still don't have a defined and documented succession plan, right? And so that's part of the issue. So that aging advisors wanting to retire, no succession plan is part of what's driving M&A in this space because there's a ton of it. We had a record 2024 and a record first quarter of 2025, and it's partially because of that, partially because it's a very attractive business model and there's reconsolidation and that stuff. But there's a gap that's not being addressed, and there's firms that are positioned to take advantage of that. So we're seeing a lot of that. And I think, that's really presenting some challenges, but it's presenting some opportunities. So I think, a lot of independent RIAs, we're still seeing like, okay, how do we find that right qualified buyer? And I think I'm probably segmenting. We probably work mostly with firms under, 2 or 3 billion of AUM. So these are not massive firms where they're still founder led, oftentimes on the first founder. Finding that qualified buyer, right? Finding, internal sometimes can't afford it, oftentimes can't afford it. External, there's a lot of options being presented, which is
Yeah.
great, right? That gives us the opportunity to literally say, how is it that you want to exit? And you can probably achieve that. But each one comes with a lot of pros and cons. So I think that's a big thing. I think the biggest thing that we're seeing right now is just a lot of options, that no succession plan, aging advisors, how to get all of that organized, which is really why we focus on really the two things. We have a 2-year partnership, or we aim to have a 2-year partnership for anybody that we're going to work through a transaction with, right? So 2 years prior to exiting, to go through the business, understanding value, value enhancement, all the things related to the business, all of financial aspects, not necessarily getting into a financial plan, but designing some of the financial strategies that can help with tax minimization and things. And then really starting to talk about that second thing, which is, call it the second act or next act, right? What is it that you're going to do after this, right? Because how you set up and plan your business for that exit is going to be heavily dependent on what it is that you're going to do after. And a lot of our clients, if you go through that process, it's really where you find that purpose and it has more meaning. And it's like, that's another level of happiness when you get there. And so that's, again, part of what we're seeing and spending some time on.
Well, it's like in life. It's clarifying expectations that you have. So when you get on the other side of whatever decision you made, if you have a plan, you can work the plan. You can meet a lot of your expectations. If you don't clarify those, there are some people that are going through this process. They get on the other side and they regret what they did because they didn't have a plan. They didn't take the time. And part of the reason why we're doing total succession is because there's just this need to try and get information out there to folks of resources like Nick's and legacy partners and other providers are out there. Just try and create a resource for advisors to start learning what they need to be doing. Because most people listening to this, you've never sold a business before or sold your own business, much less.
Yeah, and I think, I try to break it down a little bit into, I think a lot of owners, original founders, view this a little bit like selling a house because it's the only major asset they've ever sold, right? Where you're just gonna, keep going as is until I decide it's time. I'm gonna find a real estate agent and list it. I'm gonna get multiple offers above my asking price, and then I'm gonna get all my money at close as I walk out the door. That's just not how selling a business operates. There is so much more involved in that process and so many more things that come after it based on that decision. And you brought up a really good point that the number one regret for many owners after they sell is not, I chose the wrong person, I didn't get enough money, whatever it was. It's, what am I doing? What is my identity? I didn't plan enough for what comes next. I thought I was going to play golf and do all these other things, but no, finding meaning and purpose there is so important.
Yeah, some of the higher divorce rates are coming from 65 and older because all of a sudden the owner shows up at home and is not running their business anymore, and the spouse is not used to them being there, and that's problematic too. So it's making sure your loved ones are on board and you can accomplish what you want to accomplish. But I really think that going back to your real estate analogy is, I think some people, and I think this is going to lead us into valuations here, because I was shocked. Like, I got numbers and I was like, oh my gosh. But then I started realizing I think there's I think there are acquirers out there that are taking advantage of you, the business owner, and giving you a deal or putting a number in front of you that you lose sight of the math of how that number is created and what requirements are in that number. And you jump in without doing some due diligence or getting some help to help protect you from yourself. And that can put you in a precarious position, because I was shocked when you did our valuation. It was half, literally, of what the offers were. And then you educated me on why that was. So let's talk about valuation and some of the lessons that I've learned working with you that we can try and maybe teach the listener of what they can learn and what they need to pay attention to.
Yeah, yeah, and there's an interesting, I guess, kind of line in M&A that if you name the price, I can pick the structure, and you can pick the structure if I can name the price, right? Because there's so many, and there's a lot of things that go into this, but right, whether you're getting in, I'll give you 20 times EBITDA, sure, but I'm gonna structure in all the things that have to happen in your business and all the ways that are gonna allow me to get out or not pay some of that money or pay it over time. As just a deal structure piece of what you might not know going into that.
Yeah. Or what you had said to me was, or what I heard you say was, you can get any number you want. What
Mm.
you have to do to actually get the money is different. And that's buried in some of these contracts and buried in some of the math that, when I realized that the numbers I was getting that were double what your valuation was of my firm, I started realizing, wait a second, I got to grow by 140% over the next 5 years to make that number. And if I did that, no wonder they're giving me that money, because holy cow, look at what the revenues have to do to basically bring that to the forefront.
Yeah, yeah, and everything in valuation comes down to pretty much 3 buckets, is, the growth, value, and profit, right? And everything's gonna fall into one of the, what is the size, what is the profit, the amount of cash flow that I'm gonna get? What is the growth of that, and what is the risk to that? Because a lot of people, I think one of the big misconceptions that I'm getting oftentimes with people that have maybe never done a valuation or haven't done one recently is, oh, I should expect X times revenue.
Mm.
And I think you can almost throw revenue multiples out the door. They're very, very easy, um, but very, very misleading, right? If we have two firms with similar or same revenue, they could have very different EBITDA margins, very different payroll structures, very different growth, very different risks, and those are going to be valued very, very differently. And so throwing that out the door immediately is one of the big misconceptions in understanding, hey, okay, now I understand people are actually buying cash flow and the growth and risk and certainty of that cash flow, which kind of leads to other layers and the recurring revenue and some of that stuff.
Yeah. So it seems like there's advisors out there who have clearly a big misconception that if it's only based on their revenue, that they're going to be able to get whatever that they want out of their practice when they sell. So let's break that down a little bit. What do you think advisors really need to know about how their practices are being valued if it's not just based off of one key component is their revenue?
Yeah, I think, understanding the core concept of people are buying cash flow in anything that you're buying, anything that you're investing, even when you buy a stock, that's ultimately what you're getting, right? Or a lot of different things. Like, what is the cash flow? Even if you're not going to get income every year, the eventual sale of that is factored into the equation, right? Which is why, in addition to revenue and EBITDA multiples, our valuations are using the DCF, the discounted cash flow. So we're projecting out your actual business model because it's different. Some people are paying 70% payouts to advisors, some are paying solely salary, right? And those are how those companies are going to scale and evolve over time is very different, which is going to have a different value. But I think that the core concept is, hey, this is about purchasing future cash flows, not necessarily what we did in the past, not what my revenue is, not what my AUM is. And then what that relates to heavily in the financial advisor world is how you're comping advisors, right? That's a large expense line on a P&L of a wealth management firm that's probably not as high in a lot of other industries. And so to understand, and I think some advisors, a lot, especially some of the younger ones, or maybe some that came out of maybe the broker dealer or big wirehouse mindset is my business, I'm focused on the income and the revenue. I'm pulling out 300, 700, a million two, whatever that number is, and that's what I'm focused on. It's kind of a mindset transition to your business is not just income producing. Your business is an asset that has value. And you should compensate everybody fairly for the role that they're doing and incentivize them appropriately for hitting some of those hurdles or metrics that you want to track internally that are helping grow the value of that firm. And the cash flow that's left is what is rewarding the equity holders for, you know, putting up capital or founding the business or whatever got them there. But if you get a structure like that correct, now you're actually creating value in the entity. And I think that's just a big piece of valuation that is oftentimes missed, especially in this industry.
So we had another guest on that basically shared the struggle the advisors have where they go from pulling your example of, your million two out of the business and they sell the business and now their salary is 200 or 300 and they're kind of like a deer in headlights because they got all this capital, but then now they have this cash flow and they have these earnouts and they have these other struggles. Talk a little bit about the balancing act between the more you want up front, the more you want, and the sooner you want to get out, the less you're going to get, it seems, versus the longer you stay in to try and help grow it, albeit at a fixed salary in some cases or a fixed payout in some cases, depending how you structure your deal. Um, and I think the other component that's misunderstood in this valuation part is the offering of stock where you now can take rollover equity in this new company, and what risks that present.
Yeah, so a couple things there. I think as far as the comp and what you take and staying involved, I think comes back to the original principle too of, hey, we're buying future cash flow, right? And so let's just use an easy number. You have $2 million of EBITDA. Well, if you tell me that you're going to take $1 million of compensation out for the next 5 years that you're here, and that 2 million or that $1 million wasn't included in the 2 million of EBITDA, well, you've now reduced the cash flow that the buyer's buying, right? And so your value is going to go down. And we get oftentimes, owners will come to the table like, I don't know, I just took distributions and I took a base salary. We have to adjust it to like maybe a fair market value or whatever I'm going to take. And, hey, do I take 300 or 400 or 500? What you're going to take on an annual basis, right, is going to impact the value that you're getting. So the less you're going to take upfront, the larger the value is going to be. The more you're going to take in compensation, the lower the value is going to be. There's also the point, again, because it's what is the cash flow that the buyer's getting. If you're saying, hey, well, I'm going to stay involved for 3 years, 5 years, 7 years, whatever that is, and depending on whatever other roles and people are needed in your business, that's additional expenses that are still in the business, right? That are, again, going to lower value. But that might be part of what you want and what you need, and bringing that buyer's capital or synergies or whatever things go into that might be 1 + 1 is 3, which is great. And that's a good thing. But I think how you take that compensation in a transaction, how long you're involved. But then there's the other piece, if that's what you're getting to as well, is, how much you are taking in, um, as far as the purchase price, right? Am I asking 100% of that to be paid at close? Because if so, the buyer is taking a lot of risk, and therefore I would expect the price to be lower. If I'm going to say, great, you can pay me out over 5 or 10 years, right? Well, that's a big transfer of risk, right? The buyer's reducing a lot of risk. And I, as the seller, am going to have to wait. And I actually have a lot of the risk now that you just don't pay me, or time value of money, or a lot of things. So now I'm going to expect a higher price to balance some of that out. So that gets into a lot of the deal structure on, how much what is that deal structure like? Is there an earnout? How much is paid at close? How much time to get it is going to impact that. The other piece that you mentioned is just offering stock. And so when we start to introduce these aggregators and private equity firms and a lot of this, because again, if you come back to it, we're spending hopefully 2 years with these sellers before we're selling to really plan how is it that you want to exit. And again, given all these buyer options, I'm telling a lot of my sellers, you can literally write down whatever it is that's perfect for you, and we can probably go find a lot of people that will give you exactly that, right?
Mhm.
And so it's creating really strong prices and bidding wars in a lot of cases, and really good options. But when you get into aggregators and private equity and some of these different options, they're oftentimes going to require that you stay on board as the founder and that you roll equity into these deals. Now that can be good and bad, right? It can oftentimes be a second bite of the apple. So maybe your business is, I don't know, $10 million, but you retain 20 or 30% equity, right? You're going to get cashed out now for some of that. You're going to hold some equity that ideally and hopefully, if you made the right buyer choice, is going to grow significantly. And you get a second bite of that apple later when they eventually sell. But there's also some of these where, hey, we're putting this, buyer group or whatever kind of the buyer it is. Um, and maybe you're growing at 20% a year and they're growing at 10. Now you're exchanging your equity growing at 20% for equity in a larger entity, fine, but it's not growing as fast as yours. So your equity growth is helping theirs, but theirs is not necessarily helping you. It's probably hurting your equity growth. So there's a trade-off there if you're going to take equity and exchange equity. And then there comes a lot of the, how can I sell it? When can I sell it? If you sell, can I also sell? Is there a discount? Who forces it? Decisions. A lot of pieces that go into that certainly we can get into more, but that's a higher level.
Yeah, talk a little bit about, uh, I know when I went through the process of doing the valuation and, it caused me to see the business differently because all of a sudden I started realizing because 'cause it's been mine for the 27 years I've been here, right? So the company car or the legitimate business expenses that I'm running through the business that a buyer, someone else wouldn't want those, right? They're gonna want that cash flow. And going through the process of just getting a valuation, one, seeing what the business was worth was an eye-opening experience, but two, it caused me to kinda grow up a little bit and think about my business a little differently about what I'm running through it going forward, so that if something happens in a catastrophic event or what have you, the numbers are more pure. Talk a little bit about how these founders that you've dealt with have been running their business kinda out of their hip pocket, and there's some purification that's probably needed in their books.
Yeah, and it's great. It's a nice advantage to have that business to do that. I think we all do. I do as well. Is you get to run some of the expenses through the business, and some things that we commonly see. And I think you mentioned one of them was, hey, I run my personal auto through here because I use it primarily for business. We donate a lot to charity that maybe a buyer is not necessarily going to do, right? We run my golf club or my golf club membership through here because I prospect at the club and meet 80% of my new clients at the golf club that's marketing. Well, they're probably not going to pay for that.
Yeah.
But there's a number of things that owners, and rightfully so, are running through their business because they're focused on that income and that tax deduction, right? But if running those expenses through your business are getting you 1 million at EBITDA, but maybe not running them through only the legit business expenses that a buyer would actually pay for gives you 1,500,000 of EBITDA. Well, if you're going to sell and we are working together for 2 years prior, and you can now show at least 2 clean years of what that business is going to actually produce in the buyer's hands with all the legit business expenses, that's giving you a little bit more negotiating room there.
Mm.
A lot better than coming to the table and saying, hey, look, we've done 1 million of EBITDA every year. But you know what? About 500,000 of that is just my personal stuff. We could run the business without it. Because
Well,
as a
prove
buyer,
it.
I'm going to say, oh, yeah, I'd love to see that.
Yeah,
I'd
prove
love to
it.
see all these things not go through and you still generate the new client growth and low client attrition and existing client growth that you're currently doing. Um, and so it's a little bit of a trade-off, but getting that, especially if you're going to start thinking and approaching a potential sale, whether it's internal, external, whatever it be, getting at least a couple years where you're running a very clean P&L to show that enhanced cash flow and realistic cash flow that the buyer is going to get is very, very helpful.
So, what's the difference of people that you've worked with that are in a rush to make this decision, don't have the 2 years, different from the people that do?
Ah, man, I think the biggest thing, and I'm seeing this across industries, is I think their owners are really leaving a lot of money on the table. I think it's a little bit patched in the wealth management industry because there's so many buyers that they're pushing up the price, right? But really, when it comes down to it, do you really want to sell to the person that couldn't accurately assess the risk in your business? That's who you're going to have talking to all your clients and leading them
Mm,
and managing their investment strategies and their financial lives. The one that couldn't accurately assess, um, the risk appropriately and just overpaid. So I think they're leaving a lot of money on the table. Um, and I think really the whole private equity industry, not the whole, but a lot of the private equity industry is focused on that theme, right? I can find a founder led business that hasn't created the operational efficiencies and the professionalism and some of these things that are going to de-risk the business and enhance growth and all these things that are going to add value. I can find that seller, simply input all those things into the business and sell it at a profit, right? That's kind of their business model for a lot of these that work with. Not that there's anything wrong with that, but you're now allowing somebody else to extract the value from the business that you spent your whole life operating and building. And that's where I think the difference between, taking those, let's call it 2 years, planning the business, planning the financial stuff, and really starting to plan some of your personal, because that all ties together. How you're going to exit is part of your strategy, overall business strategy. That's really going to ensure you're putting more of that money in your pocket than letting the buyer get that from you.
what's your encouragement to advisors in that 2-year time frame if they've not really done that to de-risk that? How do you kind of walk them through that?
Yeah, and de-risking is a major concept that I think people need to understand, and definitely owner dependency. We see
Mm.
it in a lot of industries. We see it a lot in wealth management. I just talked to a couple months ago, probably a $2 billion AUM firm that you can tell the founder is the massively responsible for the large part of the growth. If you take him out, that business is nowhere near what it's currently doing. And I think they realized that, right? And said, okay, hey, we need to take some time and do this. What do you do? I think number one, you start to think about, during that 2 years, how is it that I want to exit? Because how you set up the firm during that time is a little bit dependent on how you want to exit. Are you going to transition internally? Are you going to sell to private equity, to an aggregator? Do you have somebody else in mind, right? How you set that up is going to depend a little bit there. Um, but the introduction of more of a team approach is a big thing in this industry, right? The more that you can get involved, other people in the firm involved, whether that's somebody directly being a lead advisor for clients or just releasing some touch points, having more of a junior advisor. There's different steps depending on where you are and where you want to get to that you can introduce, but certainly you don't want them to say, hey, I call Bob. You want them to say, I call AVC Wealth Managers, right?
Mhm.
Because that second firm has a lot more value than the first. Because if they're only calling Bob and Bob's no longer there, then I'm going to my neighbor or somebody else. I think we're at a time in this industry now where there are a lot of advisors, right? I think, 30 years ago, hey, I know an advisor. That's good. That's great. Now I think everybody knows multiple. And so, what are you doing as an advisor to separate yourself, which is a whole category, but also to ensure that your business and your clients are taken care of after you step back, after you exit, whatever that piece is.
Yeah. No, that's really helpful, and I think a lot of advisors are kind of realizing that part of their exit is actually improving their valuation and actually building a firm that's sustainable. And so part of that is important. You kind of mentioned this is like, what is that next gen readiness? If you're not even really looking forward to selling soon, there is still that question in the back of your mind of who's going to carry this business forward when I exit. So let's kind of shift gears a bit. Like, what should advisors be doing right now to start preparing those next generation advisors and even firm leaders from an operations standpoint in their firms?
Yeah, and it's gonna sound a little bit like repeating, but I think
Go
A,
for it.
planning how it is that you wanna exit is so important because it's setting the stage for that, right? Depending on who you wanna exit to, do I need multiple people as lead advisors? Multiple more people as lead advisors? Do I need a whole layer of middle management in place before I exit because of the type of person I wanna exit to? Do I need to completely relieve myself or start handing off my duties because my goal as an advisor is to exit immediately after sale? Or am I going to stay and be a major contributor in a variety of ways? Um, Maybe I'm just going to step back and sit in a client service role or just in a business development role or just manage portfolios. Whatever it is that you decide that you want to do at whatever point is going to impact that decision. But I think once you've thought through that, and it takes a little bit of time, there's finding the people and the culture in your firm and the job, the compensation structure that you're putting in your firm, all of that takes a lot of building blocks. Once you come up with that, then it's, getting the people in place. And we have a nice, we call it kind of our strategic planning document and workshop where we're taking people through some of this phased approach of, how do you want to exit? If you step back, what do you want to do? Who's in your firm? How would you want them? What's the timing of that? So it's very structured and thought through, and there's some thoughtful
Mm,
questions to kind of get you thinking about that. But that's really setting the stage for, okay, great. Now we have that.
mhm.
Let's identify, is that person or these people already in our firm? Great. What do we need to do? Maybe they've only got exposure to this part of the business or that part of the business or this background. What are some things that we're going to have to do with that person or these people over the next 2 years or couple of years to really get them in place to handle that management role or business
Yeah.
development role or whatever that is, portfolio management role that maybe they haven't had? Hey, I know they're there. I know they want to do that. I know they're the right personality and skill, but we're going to have to spend some time developing these other areas and get them some repetition. Now you have time to do that. And some people don't have that. And then, hiring's never a very easy process.
No.
I've gone through that a few times too. But, finding the person, if you build what you want first, and then the descriptions of what roles that you need in detail. Now you can more accurately go and target that person. If you're going to work with a recruiter, whatever, hey, this is what I'm looking for. It removes a lot of that guessing game that oftentimes doesn't work out very well. That's a key piece.
And as I'm listening to you and I'm thinking about my fellow advisors out there that you're listening to this, there's an aspect of you're the founder, you were the rainmaker, you helped build it, you wear multiple hats, and in order to do a successful succession, you kinda need to start checking your ego, and you now need to start letting go of some things in order to enhance the value of your company, which the ego sometimes thinks, "I'm gonna make this happen," and the more you make it happen, the less valuable your company is because it's all you, and if you're not there, you don't have that value that is the delegation that those clients know another associate where these next gen advisors can come in, and it's a lot easier to hire the advisor to take care of the clients that you have than it is to hire the advisor that's the next rainmaker because they drive you nuts, or if they really are a rainmaker, they're going to go leave you and create another shop, or you've had that experience. But it is a mind shift that needs to take place in order to make this successful.
Yeah, it's a very good point and very well said because, and that's all of us, right? That are business founders. I think you have to have that ego and some of the business development. You take risks and you have to have that confidence, which sure, that's at some point is a little bit of an ego. But you have to have that. And hey, look, I can hand it off, or you know what? I can just get it done because I know it's going to be done right. It's not going to take as long. I'm just going to do it, right? I'm very much like that. right? But again, what are you actually creating value in your asset, the firm, right? Handling that yourself over and over and over is never empowering the others to continue to develop. And we're talking here about succession. We need to empower and develop that succession if we wanted to be able to take over the business, which is ultimately what leads to more value. And I think I'll add this one small piece. I think our industry, I love where we've evolved to, but 30 years ago or 25, whenever I started, was still in the very mindset of, I don't think that we integrated young talent very well into the industry. I think if you compare the opposite, like maybe investment banking, where, hey, we picked top talent right out of top schools and we paid them really well and we paid them 120 grand back in the day and they worked for 100 hours and slept under their desk. But darn it, when they were done in 2 years, they knew a lot. Instead, it was, hey, I walked into one of the wirehouses and they didn't care necessarily where I graduated from or how I get.
Yeah.
Hey, can you bring in $50 million in the next year or two at 23? I don't know. Probably not. Right. And therefore we lost that. And so I think we're seeing a lot of, which is great, RIAs that are stepping out as they're independent and developing more talent at
Yep.
a younger age, getting getting those people into the firm, into different roles, creating that career path and career track for them, getting designations, helping them get those. And now you positioned yourself to say, hey, I do want to start creating my succession plan in 2, 5, 10 years, whatever it is. I have some good key people that have been in my firm that know my culture, that I've helped trained, that I know, hey, with some additional rounding out, could eventually take over A, B, or C role.
Yeah. Well, and part of that comes it all has to start with the advisor. Like, if you're going back to the beginning of the conversation days, like, if you're founder focused in your approach to helping them build this out, this all has to start with you, the advisor, the founder of the business. You
Mhm.
have to recognize the value in your firm can grow exponentially by you bringing other people to the table who bring different skills and talents than you to help you grow this and turn this into something else. And if you're not willing to do that, you're just gonna need to sell to somebody and throw up the peace sign and walk out the door because you're not gonna put yourself in a position to actually build that legacy that you want because 'cause you're not gonna give yourself the option or the time.
Absolutely, very well said. And again, it kind of comes down to the right. Don't think about it just like an income. This is not, I work at a wirehouse and I make this income. You have an asset that has value and you need to, take care of and enhance that asset. There was a kind of analogy of if you owned a store, like why would you just like a market, a supermarket, why would you just take food for free out of the market? Sure, it's a benefit for you, but why don't you show the increased sales and the increased EBITDA, even though it's $30 out of your pocket every time? Now you're creating more value to that entity, even though on first thought, it might be just a benefit just to take the free, steak out of there every Friday. Groom and grow the value of that asset. That's eventually going to, fund whatever it is you're doing this for, right? We always say increase the value, sell for more, get more money. Yes, yes, yes. But for what, right? Your actual purpose, your legacy that's coming later, all that stuff for a good purpose.
Well,
Your
and
purpose.
it's the spending money to make money. It's maybe sacrificing some of the increased revenues that you would normally be taking out of the business as the founder and reinvesting that in junior associates to be able to sit down with clients to have that relationship begin a transition to then allow you to service more clients because there's more people there to do it. But if you keep taking all of that net profit out of the business, you're sacrificing both growth and value in a succession because again, if you keep it all about you, it's going to be hard for somebody else to want to step in and buy that.
100%. Totally agree with that.
So, as advisors are kind of trying to retain that next gen or even build in that next gen, they're starting to understand there's opportunities there to engage them with phantom equity or paths to partnership. And so, I kind of like to talk through the impact that that actually has on your valuation and succession planning if you were to either A, you have those things in place, or B, you put them in place for the retention of those key employees in the founding partners exit?
Yeah, great question and great kind of category of things that you can do in your business. We have some specific questions, very specific questions on how are you compensating advisors? What is the turnover like? A lot of pieces related to that compensation and payroll piece. Because and certainly, and this goes into the de-risking too, do you have non-competes for these advisors? Do you have insurance on these? Do you have a buy-sell agreement? How many people don't actually, maybe they have an operating agreement because they don't necessarily know what the operating agreement says? The
Says, yeah.
operating agreement says a lot, and you should definitely know what's in there, especially if there's more than one owner, right? I get multiple, like, hey, we want this valuation for this. It's like, well, your operating agreement says you have to do it this way, right? Little bit of a side note, but yes, having the continuation, there's some sort of subjective assessments that we do in all of our valuations too about management and the depth of management besides just the questions that we ask on it. But it's a very important part because when you get down to, remember, I said the three, everything in valuation comes down to growth, risk, and profit. We're now talking about risk, right? And hey, are we going to be able to maintain this cash flow into the future? And it's because, yes, we have a whole second layer and whole G2s and sometimes G3s that are being groomed to take this over. And so it's a very intangible piece that has a lot of value. Now, it's hard to quantify that number, but it's certainly something that through a variety of different questions on our valuation questionnaire that we're trying to integrate and get a grasp of and put into the de-risking and that part. Because certainly a firm with those things has a much better certainty of continuing into the future than those without it.
Well, and what we found going through the valuation process, and we weren't able to check that box of the non-competes and different ways to retain employees. When we combined with our next gen advisors the opportunity to enter into phantom stock, so there's some money that they get if there's a change of control, came with a non-compete that you can't leave and compete against us because you're going to get this, motivated some of our 20 somethings and 30 somethings in a way that they kind of woke up. It's like, wait a second, like I can participate in a different way of the growth of the company.
Yeah.
And it became a positive thing and an understanding of why we're all signing on compete, so we can protect our team and our clients from somebody that goes rogue. Was an entirely different presentation than I've seen non-competes that just are, I don't trust you. It can have a negative connotation. And so there's some ways, and if you take the time to plan correctly, there's some ways to incentivize the team to and through a transition.
Very much so. And I think that's a great thing and a great way to retain good talent, especially some of these, you get younger, great people. They realize that, hey, you know what? I would love to benefit in some form or fashion, even if it's a small amount, from the efforts that we're putting in. And especially when you tie it to a transaction, great. Hey, we all were able to benefit from this, and I want all of you to participate. I think is a great way. I think phantom equity is one great option. There's a lot of ways to do it. Phantom equity is a good way to do it and tie it to a transaction. But I think, yeah, when you're looking at how do we make sure that good G2, G3, multiple people, and we have different owners with different feelings when we do these valuations about,
Mhm.
hey, these people have been here longer. Maybe they are an advisor, aren't an advisor, management, not management. And we want them to benefit because they've all helped build us and or build this and get us there. Is a great way. So yeah, I very, very pro, um, the value that brings to an organization to have something like that in place.
Yeah. And I think it's important for the teams that you're building that it shows that you're interested in their contributions, you value their contributions, and money talks. Honestly, there's a lot of things that you can do to appreciate employee, but money talks. And the time that it takes to go into this is really worth it. And it's not something that can happen overnight. And so I think the one thing we want you to hear over and over again is you have to put in the time. You have to take that first step. And so if you want a successful transition, it has to be thoughtful, it has to be intentional, and you can't let it become a crisis mode for you, for your team, or for your families. So I think one of the things as we kind of wrap this up is there's a lot of planning that goes into the valuation work and de-risking the business and building out your next gen strategy, and it can be a lot to take on. And so for the advisors listening to this and like, okay, I need to get serious about this. This is kind of a little bit of a kick in the pants and they're not sure where to start. How could they actually connect with you and your team, your legacy partners, so that they might see if you guys are a good fit to come alongside them and take that first step?
Yeah, a lot of ours, almost every engagement just starts with evaluation. Let's figure out where you are today, right? Because a lot of our clients oftentimes have never had evaluation. And Tyson, you even alluded to this too. There's a lot of things that we're just going to learn from the valuation. I'll have a lot of conversations with people like, hey, just send me your P&Ls and some of the data from our questionnaire. I can tell you a lot about your business and where buyers are going to see value or missing value. And we try to set up our valuation reports so it's almost like a dashboard for value enhancement. And we're currently about to roll out a whole nother layer of kind of a value enhancement initiative to complement that. Our reports, because we're getting a lot of that. Like, great, this was really helpful. I was able to see. Let me a little bit more quantify what it is and prioritize those areas and let me see where that's going to get me. So that's about to be rolled out. But I think that's just, starting with that initial valuation. Again, our website is yourlegacypartners.com. Emails nick@yourlegacypartners.com. Happy to have an initial conversation. We have very reasonably priced evaluations, I think, and I've been told,
Yeah.
compared to the rest of the industry, we turn it around in 2 weeks. And so a very streamlined process. But I think starting there will get the insight of, hey, that was a real eye opener. Sometimes it comes from the point of, I didn't realize that I couldn't provide you with the data that you needed.
Oh,
That's
I'm
very
sure.
common. We're doing two today, and it's been an ongoing back and forth about that. And it's like, okay, great. Like a buyer's going to see that. Let's just set up these easy things so that you can get the data so that
Yep.
we can do an assessment, figure out where you are, where the opportunities are, where you're strong, create a little bit of a operational dashboard moving forward on, hey, where do we focus most to enhance that value, and really start to get that plan in place.
Yeah, that's great. And kind of getting them to the square one is wonderful. So we'll make sure that we link your website and put your email in there, so the advisors listening can get in touch with you. And so one of the things I think is good if there's an advisor just kind of feeling a little bit behind the eight ball and kind of what they're looking to start in a relationship with you, what is kind of like your goal when you sit down and work with an advisor for the first time? What does success look like for you when you sit down with them so that they're feeling like, okay, this is where we're going to go with this if they feel really behind?
Yeah, our goal is to kind of get that, you know, full, I guess, value enhancement and kind of
Mm,
picture exit plan. I'd say probably exit plan is a better word in place
yeah.
because, again, it starts with the valuation and we do a ton of those, but it's what comes from the valuation and the plan that can be put in place from that, right? Because now we're saying, hey, not only do I know, I now have a plan. It relates very much to financial planning, right?
Yeah.
Creating a plan for people. And now I have a plan for what's going there, but I think really at the end, when you say, what is your, why do I do this every day? It's really about, and again, kind of says this on our website, it's not actually about the exit. It's about
Mm,
what comes next, right?
yeah.
Because you're going to do the valuation, see where you're at, figure out the plan, enhance the value, sell for more, keep more of the proceeds. And then you know what? What I actually get, like, why are you doing all of this? Okay, now I get to actually participate in, this ALS foundation because my cousin died of ALS, or contribute to the, be part of this pet deal, or help in other countries in these areas. That's kind of the motivating piece. So a little bit of deviation from the question, but
No,
it's really
makes
getting
sense.
some of that roadmap set up because the ability for them to reflect as we do with our clients, the advisors do with their clients all the time. What
Yep.
is the goals that you want to accomplish and all that? Do people ever ask us that? But think through that because we have a very weaving financial advisors, a very unique luxury, right now that there are so many buyers of different types, very attractive, multiples are higher. You can exit how you want to, right? At a good price and get most of what you want as far as some of the specifics. You just have to go through the planning and set your firm up for that, and you can capture all that rather than letting the buyer capture that dollar.
So if you're listening to this, the takeaway is, as was my experience, which is why Nick is on representing your legacy partners, is look at starting with that valuation and realize when he's talking about 2 years, your plan may be to sit at your desk for the rest of your life, but you still need a succession plan. Don't think it has to be you're done in 2 years or you've sold it in 2 years, because that may not be your plan. But there's resources, and your legacy partners is one of them, that can try and basically be a consultant relationship there to help protect you from yourself and position you well for a purchase or a succession if and when that happens. And flush out what the valuation can do is help flush out, is your team capable? Are they going to be the internal succession? Are you going to hang that financial liability to monetize your business around your family member's neck, and have the risks associated with that? The valuation can help you realize what a third party might be willing to pay, which may be very different from what you're going to think you're going to get out of a family member or a junior partner or a successor. And so reach out to Nick and start a conversation, because it benefited us greatly.
I appreciate that. Very well said.
Yeah. So, Nick, thank you so much for joining us today. And for those of you listening, we just pretty much scratched the surface on all of this. So, there's a lot more that we could unpack, from deal structures and equity paths, preparing your team for ownership. So, don't be surprised if we bring back Nick for another episode soon. And we'll be back soon with more conversations like this.
These conversations are designed to support your next move, however close or far it may be. Tap subscribe and let each episode guide you closer to a confident, well-planned exit. I've wrestled with these things myself, and that's exactly why I created something to help you do it with less stress and more direction. My book, Total Succession, is now available on Amazon. Inside, I break the process down into 5 clear steps to help you exit on your terms with confidence, full compensation, and your client's best interests at heart. You can also visit totalsuccession.com/podcast to download a free starter guide that walks you through my SPACE framework: see, prepare, act, commit, exit. Remember, you only exit your business once. Create the space to do it well. Thanks for listening. Until next time.